Hey everyone, welcome back to Corporate Decoder. Today, Hancock Park Corporate Income, incorporated HPCI, just filed an 8K announcing a major shift towards selling off all its assets and dissolving the company. And I'm seeing one huge implication for shareholders. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is essentially saying goodbye, and the way they handle this sale and breakup will be critical for what shareholders get back. So Hancock Park Corporate Income, Incorporated, a company that has been around for a while, has officially decided to wind down its operations. This is a pretty significant move, and it all centers around a plan called the Plan of Sale and Dissolution. What this means in simple terms is that the company plans to sell off pretty much everything it owns and then distribute whatever money is left to its shareholders after paying off all its debts. To understand how we got here, we need to look at a couple of things. One of them involves a loan. Imagine the company had borrowed a good chunk of money, $15 million, and had agreed to pay interest on it. Back in 2019, they made a deal to borrow this money and had a set date to pay it back. With an interest rate of 6.5% later, in 2021, they reworked that deal. They pushed the repayment date further out to November 2026, and they also managed to get the interest rate lowered to 5.5%. This was a good move at the time, lowering their interest costs and giving them more breathing room. Now, fast forward to July 2026, and there is an update to this loan agreement. This update is directly tied to the company's decision to sell everything and dissolve. It changes a bunch of rules, like how they report their finances, what happens if the company's control changes, and even what kind of business they are allowed to be in. It also allows them to prepare their financial statements differently, like on a basis focused on selling things off, which makes sense when you are shutting down. Another key event is the termination of their dealer-manager agreement. This agreement was related to how they were selling their common stock. Since they are now planning to sell off all assets and dissolve, continuing to sell new stock would not make any sense. So, they have ended this agreement. The good news is that it does not seem like they had to pay any big penalties for ending this contract early. The big news, however, is the approval of this plan of sale and dissolution by the company's board of directors. They are now going to put this plan to a vote to the shareholders. If the shareholders agree, the company will basically become a company that is selling its assets. This means they will sell off their investments, pay any outstanding debts and obligations, and then give any remaining money back to the people who own the stock. It is not a quick process though. The company expects to operate in a wind-down mode, managing and selling its investments over time. This entire process is subject to market conditions and other factors that the board sees as important. The board also reserves the right to change or even abandon this plan if they feel it is in the best interest of the company and its shareholders. Along with the plan to sell everything, the company's main goal has also changed. Before, they were focused on growing their investments and making money from them. Now, their objective is solely to get the most value for their shareholders by selling off what they have, paying off debts, and holding on to the remaining assets until they can be distributed. They do not plan on making new investments, except maybe to finish up any existing commitments they have. Here is something that directly benefits shareholders in the short term. The company's investment advisor, Offs Capital Management, has agreed to reduce its management fees. Instead of charging 1.25%, they will now charge 0.75%. They are also waiving any incentive fees or capital gains fees until the company is completely liquidated or dissolved. And crucially, they are not allowed to try and get back the fees they reduced or waived later on. This means more of the money generated from selling assets goes directly to the shareholders. As expected, the continuous offering of the company's stock has also been stopped. The board decided it was not logical to keep selling new shares when the plan is to sell off all the company's assets and close down. To get shareholder approval for this plan, the company will be sending out a proxy statement soon. This document will have all the details about the proposed sale and dissolution, as well as other important information for the upcoming annual meeting. Shareholders are strongly encouraged to read this document carefully when it becomes available. It will be filed with the Securities and Exchange Commission, and you will be able to find it on the CC's website. Now, this report contains what are called forward-looking statements. These are basically management's expectations about the future, like what they plan to do with the sale and dissolution, and the timing of events. They use words like expects or will, but it is important to remember that these are just expectations. There are risks and uncertainties involved, and the actual results could be quite different from what management is anticipating. The company is providing this information as of today and does not plan to update it if things change. So, while these statements give us an idea of their thinking, they are not guarantees of what will happen. Scroll exhibit number 2.1, scroll looking at the specifics of this plan. It is a pretty clear path to liquidation. The company will sell its assets, settle all its debts, and then distribute what is left to its shareholders. This is all being done under Maryland's corporate laws, which outline how companies can sell off their assets and dissolve. They are even considering setting up liquidation trusts if that helps make the process smoother. Essentially, Hancock Park Corporate Income Incorporated is embarking on its final chapter. The key question for investors now is just how much value will be recovered after all the assets are sold and all obligations are met. The reduction in advisory fees is a positive immediate impact, ensuring more of the proceeds go to shareholders. However, the ultimate payout will depend heavily on the success of the asset sales and the company's ability to settle all its debts efficiently. We will be watching the proxy statement closely for the detailed shareholder vote proposal. That is my take. Stay decoded. If you found this analysis helpful, please give it a like and subscribe for more. The tools I use are linked in the description.